Welcome back. In the previous two videos, we covered credit risk. We also covered rate of returns and net present value under uncertain future cash flows. In this video, I want to cover a central dichotomy in finance, the difference between debt and equity. This is really very important, so we'll have to overdo it a little. It's also the last video of this chapter, so I guess it has to be twice as long and twice as painful. Sorry. It's going to be a major conceptual leap now. We're going to look at payoff tables, contingent claims, bonds and levered equity, and bond risk and equity risk. We're going to split cash flows into debt and equity, which is an essential concept of finance. It's not going to be a proportional split, as if we were partners and I take 20% and you take 80%. Doing the split the way that we do it, you can become either a lender, which means you provide capital in exchange for the promise of a fixed amount of money, or you can be levered equity, which means that you own the asset, but only with a bundled obligation to repay the loan. We're still going to be in our perfect capital market, where every investment is fairly priced and the world is risk neutral. The expected rate of return on our treasuries and all other investments here is still 5%, and we're just going to do everything in terms of a one-year horizon. We're going to have a finance project, which could be a house, could be a firm, could be a student loan. That's going to be the central project example. In this example, next year's payoff are going to be $100 if the sun's going to shine, which has a probability of 90%, or $50, probability 10%, which may happen if a hurricane hits. Well, fortunately in Los Angeles, that's like the only natural catastrophe that we haven't really had yet. I'm going to use CS for capital structure, and the first capital structure that I'm going to consider, I'm going to call CS1. In this capital structure, you own it all. You own the project. So, what is the expected payoff of this project? Go back, take a look at this. Tell me, what is the expected payoff?
Please pause this video now, answer the question on a piece of paper, and then continue.
So I'm going to call this project overall full ownership. I'm going to call this V for value. The expected value is 90% of the time you get $100, 10% of the time you get $50, thus $95. What is the appropriate price for this project?
Please pause this video now, answer the question on a piece of paper, and then continue.
We take the expected value of $95 and we discount it by the appropriate opportunity cost of capital, which in this world is 5%. So the appropriate price today is $90.48. What is the promised rate of return on your claim? Promised is what you get in the sunshine state.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the value, the cost, the price of this project today is $90.48. It's going to go in the good state to $100. So your promised rate of return is 10.53%. This is the rate of return in the good state. What is the rate of return of the project in the bad state?
Please pause this video now, answer the question on a piece of paper, and then continue.
You've bought something for $90.48 and you're only getting $50 for it. So conditional on the bad state, your rate of return is minus 44.74%. What is the unconditional expected rate of return on your project?
Please pause this video now, answer the question on a piece of paper, and then continue.
based on prices and values, we have something that's going to be worth on average $95, costs $90.48. That's going to be 5%. This can also be calculated directly based on the returns. 10% of the time, you're going to get 44.74 negative percent. 90% of the time, you're going to get plus 10.53%. Average those appropriately, you have 5%. We will now consider the same firm, but under a different financing scheme. Before I do this, I want to make one side comment. Everything so far has limited liability, and that applies to almost all financial claims that are in use today. This means you're on the hook only for what you invest and no more. Both debt and common equity in financial markets almost always have limited liability. If you have a small firm and you go to the bank, very often that's not really the case. They will ask you to basically put down your house and your labor income as collateral. Similarly, if you are an investor for Lloyd's of London, those are actually called partners or names, and they have unlimited liability. So if whatever they are insuring goes under, the ship sinks or something like this, they can lose their house far more than they've actually put in. Now, limited liability was a central finance innovation of the Renaissance. It wasn't known in medieval or Roman times. It came into wide use in the 18th and 19th century. And what it did is that it made it possible for owners to hand the control of the firm over to managers and not have to worry about their entire livelihoods. The president of Columbia University wrote in 1911 that he thinks that the discovery of limited liability was more important than that of steam and electricity. Maybe that's overstated, but not much. It is this limited liability that made it possible for you to easily give money to somebody else to undertake ventures. Now, you can finance a project in one of two ways. You can buy it outright without a mortgage with financing from your own savings account, which is what we just did. This was our capital structure CS1. Or you can buy it by taking out a mortgage and only put a smaller sum of money, your own skin, your own equity into it. You then own just the residual levered equity, but you also only get to keep the payoffs after you will have fully repaid the mortgage. But you only had to put in much less money. This is going to be our new capital structure, CS2. What's stock? Stock is just a different word for levered equity or levered stock. All the same thing. It's much easier to say then, what is left after all the debt has been paid off? A stock levered against $10 is not the same as a stock levered against $20. It's like apple and oranges. In the second case, whatever you have as stock is not going to get as much as what you have in the first case. Stock market sounds a whole lot better than levered equity market too. So our CS2 example is going to work with a specific example. We're going to want to finance the purchase of our firm with a loan, which I'm going to call B, a bond, promising $50. This is part of our CS2 capital structure. And of course, we still assume perfect capital markets, risk neutrality, same 5% expected rate of return. Our bond promises $50. The levered equity gets all the rest. In the good sunshine state, how much does the bond get and how much does the levered equity get?
Please pause this video now, answer the question on a piece of paper, and then continue.
The bond gets $50 and the stock gets $50. There's $100 in the firm. The bond has promised $50. It gets everything that it was promised. The stock gets everything that is left over. In the bad hurricane state, how much do bond and levered equity get?
Please pause this video now, answer the question on a piece of paper, and then continue.
That is going to be $50 for the bond and nothing for the stock. After the bond is paid off, there's nothing left for the stock. Remember, $50, it's what's left if the hurricane hits. What is the promised dollar return for the bond be?
Please pause this video now, answer the question on a piece of paper, and then continue.
$50. It's risk-free. Gets $50 no matter what. What is the expected dollar return payoff for the bond?
Please pause this video now, answer the question on a piece of paper, and then continue.
Still the same, $50. Bond is still risk-free. In both cases, you get $50. 100% $50. What is the appropriate price of the bond today?
Please pause this video now, answer the question on a piece of paper, and then continue.
Every asset has to earn 5% in our scenario. Therefore, the price of the bond is going to be the expected cash flow, which here is $50, divided by 1.05, which is $47.62. What is the promised rate of return on the bond?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, it's still 5%, not too surprising, because it's risk-free. What is the promised dollar return for the stock S? Now it gets more interesting.
Please pause this video now, answer the question on a piece of paper, and then continue.
$50 in the Sunshine State. What you should be getting is $50. Remember, quoted, promised is what happens in the best outcome. What is the expected dollar return or payoff for the stock?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, 90% of the time you're going to get $50. 10% of the time you're going to get nothing. In sum total, you get $45. What is the appropriate price of the stock today?
Please pause this video now, answer the question on a piece of paper, and then continue.
The expected amount of money that you're going to get on the stock is $45. Everything in this world gets discounted by 5%. So the appropriate price is $42.86. What is the promised rate of return on the stock?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the equity costs $42.86. In the good state, it's going to get $50. In this case, if you buy something for $42.86 and you get $50, your rate of return is about 16%. This is what an entrepreneur impresario will try to get you as an investor to focus on. Not the probability that you will lose your money, but the probability of what you can get, not the probability, but what you can get if everything turns out all right. What is the total price or value of the firm V, which now consists of the bond and the stock?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the value is the bond and the stock. The price of the firm is going to be the price of the bond plus the price of the stock. Add those two together, and it's $90.48. Has the total project value changed in this capital structure CS2 relative to the full ownership structure CS1?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, hasn't changed. It's $90.48 either way. The value of the firm is the total value of the cash flows. We haven't manufactured anything out of thin air here. So everything, the people, the equity, the stock, the value, everything together always has to come to $90.48. So let's put all of this information into a table. I have made the table for you. I have the two capital structures on the columns. So CS1 is the third column. I have CS2, bond and equity. I've also put in some numbers in there so you have a guidance of what it is that I want. I've put in the probability for you as well. Now, the things below, of course, don't have any because they're not conditional anymore. It's only in the first two rows. So please fill in all the missing cells in this particular table.
Please pause this video now, answer the question on a piece of paper, and then continue.
Here is the filled out table. It's all the numbers that we have previously computed. In the case of the hurricane, the equity gets nothing, the bond gets 50, the firm, if it's just one firm, capital structure 1, gets all the 50. In the sunshine state, $100 for the firm, the bond gets 50, the equity gets 50. The expected payoff is $95 for the overall firm, $50 for the bond, $45 for the equity. And as you see, they have to add up again across all the row here. The expected rate of return is the same, no matter what security we're issuing. And finally, what we need to do is just discount with the 5% from whatever the two rows above was. So we've got the $90.48 and the two securities we just worked out, which together also come to $90.48. In the bad hurricane state, what is the rate of return that the bond and the levered equity receives?
Please pause this video now, answer the question on a piece of paper, and then continue.
%, minus 100%. In the good sunshine state, what is the rate of return that the bond and the levered equity receive?
Please pause this video now, answer the question on a piece of paper, and then continue.
%, 16%. Now what I want you to do is draw a histogram of the return distributions for all three forms of ownership we have considered so far. So you could either own the whole firm, just the bond, just the equity. And remember, in a histogram, the x-axis are the values and the y-axis are the probabilities. Here's the bond. 100%, you're going to get 5%. You know for sure this is what you're going to get because this bond is risk-free. Firm. Well, you can see how the distribution has already spread out. You get relatively higher rate of return if everything turns out well, and much lower if everything turns out badly. And then finally, here is the stock, where it goes even further to the sides, so it's even riskier. So let me go forth and back once more. Bond, entire firm, levered equity. Now, we really don't have a bond in the first capital structure, so I can't compare them. But if we had had a bond with a promise of very little, it would be risk-free too, which means that in capital structure 1 versus capital structure 2, the bond really is equally risky. It has no risk. What about the stock? Is full project ownership, zero leverage as in capital structure 1, or the levered project ownership with a $50 bond as in CS2 riskier?
Please pause this video now, answer the question on a piece of paper, and then continue.
The CS2 levered ownership is riskier. If you look at the histogram again, the total rates of returns are closer together for the firm than the levered equity rate of return bars are together in CS2. So the levered equity is a lot riskier. You can also work this out if you want with all the formulas that we did earlier. The standard deviation of your rate of return on the value for unlevered equity was only 17%. If you do the levered equity, it's 35%. It's twice as risky. What have we done with capital structure? What does leverage do? A capital structure with leverage splits a project's payoffs into two components. One, a safer than the project bond, and two, a riskier than the project bond. You can outsource the safer bond to specialists. So there are people that are just very good at holding bonds. They have a lot of cash, but they really aren't experts at assessing risks. So we can sell the safe bond to them. Then we have a part left that's riskier equity that we can again outsource to somebody else who's a specialist, like an entrepreneur, or we may be the entrepreneurs themselves. That's the big advantage of having leverage and equity. Now let's do some more interesting capital structures in which the bond is not risk-free anymore. This will be getting very close now to how you should think of corporate debt and corporate equity. We're going to price a bond in the same example that promises $70. I'm going to set up the same table for you. You should enter everything you know, work down the project without financing first, then work down the pricing of the various items, and then work back up the pricing of the equity. So here's the starting table. I have the hurricane probability, the sunshine probability. I've done the capital structure if there is no bond, and I want you to work out my CS3 capital structure in which the bond promises $70. Where does the $70 go?
Please pause this video now, answer the question on a piece of paper, and then continue.
This is where the $70 goes. So it basically says we have promised the bond $70 when we have it. We're not going to have it in the hurricane state because all that we're going to have there is $50. But in the sunshine state, we have $70. What about the other three CS3 payoffs?
Please pause this video now, answer the question on a piece of paper, and then continue.
Here are the other three fields that we wanted to fill in. $50 for the bond if there's a hurricane, which is all that is still available, whereas the equity gets 0 in the hurricane state and 30 in the sunshine state. Now what I want you to do is fill in the other 6 fields. My advice is to work from high to low.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, these are the remaining fields. We first work out the expected payoffs, which means that with 10% probability, I get 50, and with 90% probability, I get 70. That gives you $68. Do the same for equity, that gives you $27. 5% is the expected rate of return that every project has to offer. That means that the price of the bond today is $64.76, whereas the price of the equity is $25.72. Please check your work. Make sure you've got that. Now, working with contingent payoff tables is so important that we're going to do that with one other capital structure again. This time, however, we're not going to promise a certain amount of money to the bond. We're going to go to our investment banker and say, we want to issue a bond to raise a certain amount of money. And this is capital structure 4. We are going to want to raise $60 by issuing a bond. Question: where does the $60 go?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, this time it has to be the price of the bond. So it has to be the price today. It goes at the very bottom. Work out all the other fields for me, please. And then tell me, how much does such a bond have to promise?
Please pause this video now, answer the question on a piece of paper, and then continue.
There they are. I filled in all the other fields. In this particular case, the bond has to promise $64.45. The equity in the Sunshine State is going to get $35.55. Now, everything you learned generalizes. I've just done this with sunshine and hurricane and particular probabilities, but you can do this with any distribution. Everything can be done with normally distributed returns too. In this case, the curve would be perfectly smooth. So here's everything with normally distributed payoffs. On the x-axis are the promised payoffs. On the y-axis are the expected payoffs. If you promise less than $50, it's a risk-free bond. If you promise $60, it's, well, a little bit slightly below. By the time you get to $70 or $80 or $90 promise, the firm can no longer fulfill what the bond was promised. So it's everything just the same as we did in our example, but with continuous payoff promises. Now, why is it called leverage? Well, there's mechanical leverage. That means a small movement in a lever can create much bigger or smaller movements elsewhere. And the idea here is pretty much the same thing. So if you have more leverage, more bonds, your equity all of a sudden, small changes can then make big differences in the equity. So with leverage, you get more upside and more downside. You can create leverage also in a different way. We've done it with financial leverage. You could also do it with operational leverage. That is, you scrape all your money together, and instead of buying the building, all that you do is you lease the building, so that your investment is just in the particular risky aspect, not in the building that's fairly safe. You can deploy 100% of your money in the risky technology. Finally, remember, we can discount nominal payouts with nominal expected rates of return, come to the same result as with real payouts with real expected rates of return. We've already done that. We also know that we can discount expected payouts with expected rates of return. Done that. What about promised payouts with promised rates of returns? Is that also okay?
Please pause this video now, answer the question on a piece of paper, and then continue.
Generally, no. You cannot discount promised payouts by promised opportunity costs elsewhere. Promised discount rates, promised cash flows are all irrelevant. They're funny numbers. They can come with different probabilities of failure. So we can never use promised payouts, promised rates of returns. Anything that we do that is interesting has to use expected numbers. And of course, expected numbers are not printed anywhere. The only thing that ever is printed is promised numbers. That's it for this video, for Chapter 6, and for working with uncertainty and credit risk. In the next chapter, it'll get to be real fun. We'll look at data, the historical rates of returns of many different stocks and asset classes. See you soon. Bis bald.
What is the difference between bonds and men?
I don't know.
One of them matures.
Which one?
Good question.